For the next video segment, I'm going to go ahead and delve into one of the ways of measuring GDP. While we can measure GDP as income or as production, the most common way we measure GDP is through adding up spending on final goods and services. And we have an accounting identity, which is a sort of formula that is true by definition. The way we're going to define all these variables, this formula is always going to be true. And we're going to see this a lot over the course of the class. And the idea is that GDP, which we use Y for here, GDP equals consumption spending plus investment spending plus government spending on goods and services plus net exports. And net exports are exports minus imports. So let's talk about each of those a little bit more. So consumption spending is the biggest component of GDP. And so sometimes when people say the economy is consumption driven, they're exactly right. Now, when you think about it, what else would you have the economy be driven by? You know, sort of the point of economic activity is consumption. And that could be, could be consumption of food, it could be consumption of unhealthy food, it could be consumption of healthy food, it could be consumption of, tabloid journalism, it could be consumption of literary journals. Consumption itself, we just add up the value. We don't sort of judge whether it's good consumption or bad consumption. We often do break up consumption spending into three major categories. So there is spending on what we call non-durables, and these are things like food or clothes or that kind of stuff, and typically smaller ticket items that are used up or replaced within 3 years. Consumer durables are more expensive and more durable things like furniture or appliances or cars, that kind of thing. And finally, services, which would include things like spending at restaurants, because mostly what you're paying for is the labor there rather than the food, or going to the movies, or you hired a lawyer or medical care or something like that. Those are all services. Included in the category of services is the rent that you pay, because you're paying for what we call housing services, and also the idea of what we call imputed rent. So one of the ideas here is that if you're living in a rental house, of course, you're being supplied with services by the owner of the house. Then if you bought that rental house from the owner, if we just counted rent, then GDP would fall. So what we do is that when people buy houses or own houses, the people who calculate GDP at the Bureau of Economic Analysis and so on and so forth, calculate what's called imputed rent, which is how much would you have to pay to rent the house from yourself? Because otherwise, the amount of GDP that we have is going to go down if people buy their own homes rather than renting them, even though the actual housing services are the same. What we'll notice here is that the reason why we split out non-durables versus durables is that consumers behave fairly differently on non-durables versus durables. In particular, people often finance durables over a period of years, or at least the durables are sort of big, lumpy expenditures, all or nothing. And so consumer durables expenditures react much more strongly to consumer confidence, people's estimate of how likely the economy is to grow and how likely they are to keep their job or not. Whereas non-durables, people's spending isn't so sensitive. Services we separate out because the first two categories are tangible goods and services are intangible. Purchases of newly built housing are actually not part of consumption, and that's a little bit arbitrary, but once we think about it, it'll actually make sense. And to see that, we're going to move on to our next category, investment spending. And this is a very tricky category for people. Investment spending is spending on actual stuff that enhances the economy's ability to produce goods and services. So if a company buys a factory or builds a factory and puts some equipment in it, that counts as investment spending. It spent money to acquire something that raised productivity. But when an individual investor or a mutual fund buys stock in a company, that doesn't directly add anything to the economy's productive capacity. Essentially, it's a purely financial transaction at that stage. Now, that stock purchase might eventually finance real investment spending, or it might not. But if it does finance real investment spending, we'll count it at that stage. We include our newly built housing in investment spending because when we build additional housing, we're adding to the nation's capital stock, and we're adding to its ability to produce goods and services for many years to come. A well-built house can last 100 or more years, of course. And the other reason for this is that investment spending tends to react very strongly to financial market conditions because many times firms borrow to finance their capital investments. Likewise, consumers almost always borrow to finance their housing purchases. So both types of investment spending, both business investment spending and residential investment spending, react strongly to interest rates and other financial market conditions. Last thing here is what's called inventory accumulation. So if a company cuts down a bunch of trees and builds up a big stockpile of trees, but it hasn't converted them into lumber yet, it's increased its ability to supply goods and services next year because it has a lot of raw materials that it can work through. So when a company builds up inventory of raw materials, that counts as investment spending. Also, if a company builds up a big stockpile of lumber, then it's increased its ability to actually sell lumber in the future. So when a company builds up an inventory of finished goods that aren't sold yet, that's also investment spending. Now this is a kind of tricky thing. We see sometimes actually that when inventories of finished goods rise unexpectedly, that could be because firms didn't realize demand was going to fall, or they didn't estimate the proper production level. And so then what they're likely to do in the near future is cut back on production and try and work off that excess inventory. So we see sometimes that an unexpected spike in inventory accumulation can be a sign of slower economic growth in the immediate future. This distinction between what counts and what doesn't count as investment spending is often tricky for students, so I'm going to go ahead and let you guys think about this question. And I will go on to the G in the Y equals C plus I plus G plus net exports equation. So government purchases. Government purchases are about 18% of GDP. And if you sort of remember some of our previous lectures, you'll notice there's a little bit of a mismatch here. That 18% of GDP is less than federal spending. And that's because you'll notice that we're not saying that G is government spending, we're saying that G is government purchases. And what's the distinction there? The idea here is that if the government hires someone to do a job, or if it buys some asphalt to put down on a road, or if it buys a battleship, or who knows what else, then it has used up tangible goods directly. On the other hand, if the government pays someone a social security check, or an unemployment insurance check, or a farm subsidy, or something like that, then it hasn't directly used up resources. Instead, it has moved resources around within from one part of the private sector to another, and then ultimately that social security money or unemployment insurance money is likely to show up in consumption spending. Because unlike the purchases of asphalt, the true final decision maker on those spending decisions is going to be the consumer at the household level rather than a legislature or other government entity. So, last category here is the category of net exports. And again, net exports are equal to exports minus imports. And net exports are negative. They're negative 2.7% of GDP. So, essentially what we're saying there is that the United States imports more than it exports. Another way of thinking about this is we're using more resources than we produce domestically. And we bring in imports to fill the gap between what we produce and what we use. But at the level of GDP, why do we subtract out imports? And the idea is that we want to maintain consistent counting, and we want to count correctly the true amount of economic activity that happens within U.S. borders. So as I lay out in this little example here, we could have avocados being sold in the Safeway for $2, and some of them Safeway bought from U.S. farmers, and so both there was $1.50 of agricultural activity and 50 cents, going from $1.50 to $2, 50 cents of transport and retailing activity. But at any rate, all $2 of the production occurred in the U.S. So, on the other hand, some of the other avocados Safeway bought from Mexican farmers for 75 cents, and so in this case, 75 cents of the economic activity occurred in Mexico and isn't part of U.S. GDP, and then the markup between the 75 cents and the $2 is economic activity that did occur in the U.S., whether transportation or retailing or who knows what else out there. Here's a couple of thought questions on the next couple of slides. If the U.S. imports less, how is that going to impact foreign GDP? How is that going to impact GDP in Mexico or China or something like that? And then, if foreign GDP declines in reaction to the U.S. importing less or something like that, how is that likely to impact U.S. exports?